Hi, everybody. Welcome to Parallel Systems. We are joined today by a new guest. Her name is Samantha LaDuc of LaDuc Trading. She's a very talented macro analyst who helps her clients manage risk and earn money in the process. So, thank you so much for joining us, Samantha. Is there anything that you'd like to add to that introduction? Maybe just where listeners can find you if they want to follow up on this interview?
Sure. Yes, I run a financial research firm, and we can be found at LaDucTrading.com, LADUC. And I'm actually joined by a whole bench of analyst educators and traders. We fill up from macro to micro. So it's very much, I'm kind of head market timer, but I do use macro as a backdrop as a way to also find durable trends, sector rotations, stock selections. We've got live trading rooms, portfolios, and the like. So we kind of serve retail and institutional. It's not just macro, even though I know our discussion is today. But that's basically it in a nutshell. Financial research firm is how I kind of.
Awesome. Yeah, and actually a paid subscriber of your Substack too, which is fantastic. So I will tell
Oh,
listeners that if you are not an institutional investor, but you want to find some of Samantha's work, go to the Substack because that's really good. I'll put the links in the description. Samantha, you mentioned macro. I'm a gold guy, so I would want to speak about it anyways, but I actually have a very good excuse because this year it's up 55%. So it's the best performing asset class by a long way out of the main ones. And it's really fulfilling the narrative that a lot of us, well, we used to get called gold bugs, have had about the loss of faith in the dollar, in sovereign debt. So, as a seasoned macro analyst, how are you reading this, Samantha? What is the driving force behind this massive move in gold?
well, we definitely have a lot to talk about there as it relates to the macro winds of change. First and foremost, we started getting into gold back in the November 1st, 2023, when Fed pause and Yellen Yahtzee started becoming a thing, which is basically loose monetary easing. And then you saw what happened in the spring of 2024, where gold finally broke out of a massive base, and then silver followed the next month. And I'm very fortunate to work with a classical economist by the name of Jeffrey Fouvray, who is brilliant and very well versed in emerging markets. So he saw this as a transition to fiscal dominance long before it became a catchphrase in the media. So he's very well versed, and basically this orchestration by the White House, by the way, then Biden, now Trump, but the White House, Treasury, and Fed to continue to suppress yields and try and evade the fact that the value of the dollar was at risk through this dual deficit of trade as well as fiscal. So unless or until our U.S. Trade and or fiscal situation is restructured and under control, this is a beautiful tailwind for gold against the de-dollarization move with BRICS, where China in particular, not just hoarding at the central bank level, but also settling trade outside of the U.S. dollar, outside of U.S. treasuries, outside of the petrodollar, is giving fuel for the fire of this run. And then, of course, it morphed into something much bigger of late, which is after all of this additional, follow through with precious metals, which gold, by the way, always leads. It then goes into industrial metals, right, from precious to industrial. And those are all very inflationary. And we've had outperformance by the miners, which have been a fabulous sector rotation theme since spring of 2024. And they're now in a parabola, which is where I just warned recently, as you know, take care, because this rate of change in the price appreciation for precious metals, once it stalls, it will pick up wind on the downside. And we have lots that we can cover regarding why it has picked up so much energy. But in large part, it is this combination of the debasement trade, the de-dollarization trade, the devaluation policy by the Trump administration. Even before he was elected, he said, I'm going to do tariffs. And the more the dollar falls in value, it was overvalued, the more tariffs he raises. So this was a policy feature. This is not a bug. So, and you notice what happened in the spring of 2025. We had a big drop, not only in the dollar, right? We're down like 11% in Dixie year to date, but also in equities and in bonds. So they're not buying longer duration notes and bonds because the Treasury keeps stuffing the short duration, which is liquidity fueling for the equity markets, but it is also a debasement, right, on the dollar, which is also helping this equity melt up. It's all related, long story short. So China settling trade outside of the US dollar and does not plan to buy US treasuries, does not need the petrodollar, which is related to oil, right? They are bypassing and going Iran, Russia, etc., but also they are stimulating their economy by migrating away from oil and into electric vehicles, which is a massive stimulus for their country. And they're continuing to settle trade in gold outside of the dollar. So the trend isn't going to end as far as the macro tailwinds. And now you've got, the wirehouses, the JP Morgans and the Morgan Stanleys here in the US saying, okay, now we're under weighted in these, gold and silver holdings. We need to increase our allocation from 5% to 15 to 20%, right? They're not saying that about crypto and Bitcoin. They're saying that about gold. So I think that this is what is part and parcel of this race to get exposure. At the same time, Trump, I know it's a long answer, but there's a lot involved in this. Trump fired Lisa Cook, a Fed governor, and on that moment, after gold had consolidated from literally April until August, you saw the September breakout in gold, which has been nonstop. It's been breathless. Silver follows. It's been breathless. So this removal of Fed independence, this threat by firing a Fed governor, is unprecedented, right? So that is also what triggered some of this most recent bid in precious metals. And now we've got a trade war, and Fed can't print precious metals. They can't print rare earths. They can't print batteries. They can't print any of the things that we really need for this expansion of our AI data center build out and the rest. So folks are getting wind of this and seeing that gold is really the best alternative to a very leaky ship, which is, in fact, the U.S. fiscal spending and treasury market and dollar.
Well, there's so many different ways we could take that, Samantha, because it feels like what you're telling us, and this is my view too, is that most of these things are actually structural. It's not short-term trends. These are big structural changes that are happening. And one thing that I was trying to get my head around recently, and I'd love to get your take on it, is it really does feel like if the US are telling us that they're going to devalue the dollar, really they're also saying that the gold price has to go up because they're kind of at the opposite end of a seesaw. And then you've got Europe who have massive debts that seem unmanageable unless they had something to offset that with. And we know that Europe has accumulated, most nations now, around 4% of GDP in gold. And then you've got China who have a lot of gold too, and consumers who maybe were hurting from the collapse of the property bubble, but they have a lot of gold in terms of their consumers as well. So it kind of feels like all three may, and this is just my take, may have a vested interest in a higher gold price. Is that correct? Is that how you're seeing it? Like the letting gold run, so the ceiling might not be where people would assume it would be. It could actually go much, much higher, even though we've seen, a massive run up this year.
We've actually seen a massive run the past 3 years relative to SPY and Bitcoin, for example. Gold has outperformed on a 3-year look back. It's not just this year. It's not just 2024 in spring where it really got busy. But on a 3-year look back, gold has outperformed SPY and Bitcoin. That's a powerful macro trend that isn't going to go away. Central banks aren't done settling outside of US dollar, treasuries and petrodollar. This is a very big, important impact to say, hey, by the way, China has a plan. You know how active their retail, you were just talking about retail investors, which in the US, we don't really have a strong retail base of gold and silver hoarders, right? We got the gold bugs, the silver bugs, but that's a unique little, group. And that's not what I'm referring to. I'm talking about as a culture, we've got India and Southeast Asia, massive gold hoarders at a retail level, right? This is a cultural boon for their economies also. I've read, 1.6 trillion was just added to the consumer base in China because of their gold and silver holdings. And we're not getting that here. What's over here in the US and Europe to a degree, of course, is our preoccupation with Bitcoin, crypto, all of this stable coin busyness, which, you know, is dangerous. So this, I believe, and Jeffrey has done an enormous amount of research on this, my colleague, that it really was intended, a contrived, if you will, play as an off-ramp to inflation, which obviously a bid in metals is very inflationary, right? Whatever the metal, doesn't matter the metal, the mineral, the metal, the miner, it's all very inflationary. But this off-ramp for inflation in, uh, bidding up stable coins and the government contrived plan to use stable coins is really to delay the exodus out of dollar. So when the dollar falls, Bitcoin and crypto will follow. Many people confuse that. They think that this is the anti-fiat trade. Oh my God, they couldn't be more wrong. So this is basically just a delay tactic that is only preventing a further fall in the dollar. So I think that this is something that maybe isn't highlighted is the wealth that has been created by, especially in China, those who own gold, and the underlying has been doing extremely well, not to mention the balance sheets of governments, central banks that hold it as a reserve asset. And here we're pumping, stable coins, which I affectionately refer to as stable cons, or so there isn't the same. Now, my thing is, I'm wondering, we're going to get to a situation where all those, what do they call them, hodlers of Bitcoin and crypto and the rest, and these treasury, crypto companies don't say, maybe we picked the wrong horse. Right. And then that will even further support the trajectory of gold and silver advance. The only thing that is bearish, the precious metal run right now, is, of course, what I just talked about, which is short-term volatility. And I can see that happening because the rate of change of this price move is not sustainable. It is a parabola in the short term, right? But it'll get defended even after it comes back. The only thing that would create a macro change of view for me is if we had trade balanced or fiscal restructuring. That's the only reason to not be uber bullish the precious metals. And what are the chances for that?
Yeah. Well, historically, the probabilities are low on that one. I don't think the US is going to be able to fix these deficits anytime soon. So, yeah, maybe gold it is. But you picked up on some very important things there. The first one was that lack of correction that we had earlier this year. I think a lot of us were thinking, well, I hope it goes back down $400-500 so we can accumulate some more. And it just went sideways and then like a hockey stick again. So that's one of the key lessons, I guess, is in a raging bull market. It's very hard to get in if you're not already positioned early because, those pullbacks might not come. So that's difficult. But going back just a second to the Bitcoin and stable coin thing, we had the NASDAQ down 3.5% on last Friday, and we had Bitcoin down around 12%. And I'm just wondering when it's going to click that Bitcoin still, and it's not a safe haven, it's still a leverage play on the NASDAQ. And if we see the NASDAQ down 40-50%, which I know you've spoken about in terms of your recent articles about what happens when the AI bubble starts to fall apart, then there's going to be a lot of wealth destruction. And again, those that have the means after that, surely they're going to then look for a safe haven again, which is going to be gold. So there's a lot of interesting dynamics. And going back to what you said about the US, they're not. I mean, they're pushing people into Bitcoin, I guess, because unlike China, if the US starts saying, yeah, you need to buy gold, that's kind of like the US saying you can't trust our dollar. And as the holder
Yes,
of that
correct.
dollar, it's a pretty bad look, isn't it? If you start telling people to buy gold, I think the rest of the world would take that as a big signal. Maybe the US is going to default at some point. So, yeah, these are huge changes, Samantha. How do you make sense of them when you zoom out at the 10,000-foot view? Like, are we going into some kind of new Bretton Woods moment eventually? Is there going to have to be a global restructuring? Can you see that far ahead?
Well, on the revaluing side, revaluation for gold, I think that is a little bit overdone narrative right now because I do believe that this is something that's kind of last resort. So we already have the macro trend where there is falling demand for US dollars from the BRICS de-dollarization, from China clearly announcing they do not want any more treasuries, right? They are tied to their own, economic growth and consumption, and they're doing fine, by the way. So the fact that their economy, gets a bad rap in the media, but in real terms, they are in a dominant position for the physical commodities. They also have other markets that they are selling into. So their export trade is doing quite well, thank you very much. And their citizens are experiencing a rate of change in economic outlook because of the falling price of energy, which they had to import before, right? Now, so they're not as reliant on oil. There's falling global oil demand, and that serves as a stimulus. At the same time, the rising price of the underlying gold and silver, which they have, obviously accumulated smartly over the years and strongly of late. So I think that this devaluation on the U.S. side is less likely in gold, but it is very clear that they are using crypto, Bitcoin, stablecoins, the whole thing as a way to export. Right, some of their inflation, of our inflation, and also to use it as an off ramp in the U.S. We are in a monetary bubble, right? So the only difference that I would say is that it's backed by nothing. So we don't have we have it in abundance right now, this monetary illusion, this money bubble. We've got tons of liquidity and it's sloshing about. But it's kind of like Argentina in a way, in that, do you really want to buy pesos when they keep falling? So the dollar is similarly situated right now, and it doesn't mean it's not the absolute vehicle for transactions, and that's not going to turn around overnight. But I don't think that China wants to become, the hegemony of the world. They don't want that at all, because it always ends the reign of a country in time, right? Eventually. So I think they have decoupled. And now the Trump administration is trying to isolate them further, and maybe without thinking through all of the ramifications about how we are really getting not just protectionist policies that will help further erode the purchasing power and the risk parity of the dollar, but how it weakens us as the risk-free rate of the world is now being usurped and bypassed, and they're saying, nope, we don't actually trade, we don't trust it, we don't want long duration bonds, we don't want the dollar. We'll take your equities because that's part of the monetary illusion and the money bubble, right? We've got fabulous forward growth that has been pulled absolutely from 2029, 2030, as it relates to earnings in our rambunctious AI, extravaganza. And now we've got the parabola after parabola in sectors that are related to the U.S. government serving as venture capitalists. They're buying, shares in companies that supposedly have, the advantage of rare earths and critical minerals and or batteries, but the reality is we don't. So they haven't been found yet, or there's a wheelbarrow full in some cases, just like the AI mania. In the AI mania, there will be absolute winners where the trajectory is wow, right, in their earnings growth. I've been, very active, as you know, in ASTS, which is space mobile satellites, and that has taken off ridiculously from $25 to $100 in a pre-revenue status because they have a pipeline. They're now also of contracts, and the U.S. government is coming in and taking ownership stakes in uh, industries that are related to defense, related to drones, rare earth, satellites. I mean, I could go on and on because we have to reshore. So it's creating these manias in not just AI or data center build out, but it's putting the cart before the horse. We still need a relationship with China as it relates to batteries. We don't make them here. And our partnerships with South Korea and Japan, by the way, those three companies are totally tied to China's rare earth minerals and materials that need to be shipped for them to make these products. And now you've got China fighting back very effectively with Trump in the trade wars, not only settling trade outside of dollar and treasuries in gold, but also saying now we're not going to let even companies that like Taiwan Semiconductor that makes their products that then are used by Apple and Nvidia. We've got a rare earth ban that will affect the largest mega cap tech companies in our ecosystem, right? I think the top 25 companies in the world, 22 of them are US, right? It's massive, massive. And then within the US, we've got concentration risk of earnings that has created this parabola, for lack of a better word, in the moats of the Silicon Valley plays that are at risk with a rare earth ban. They, I think, make up 50% of Taiwan Semiconductors, as far as Nvidia and Apple, the two largest customers. So none of that's getting priced in right now because the market still thinks we're going to go and see Trump basically pull this all back and repeal and taco and whatever the trade war mantra is today. And everyone thinks that the Fed is going to also fix this, but the Fed can't print any of these materials, right? And the Fed is absolutely between a rock and a hard place as inflation is sticky and rising, and employment market is very weak. So we've lost our buffer also in the labor market. So I think everyone is that is in kind of the real world is saying there's some hardship coming to Main Street. Wall Street isn't pricing it in, but the Fed actually can't fix this. And Trump is, hell bent on a trade war with China. He's going to get one. So I think that gold is obviously a play on this fiscal malfeasance and, geopolitical risk rising, because when you also have a capital war, which we're in, specifically with China, then you oftentimes lead into more, unsavory acts and accidents. So I think gold has so many reasons for being bullish, big picture. But I would warn that in October, I've got some tremors here of volatility that could interrupt this parabola for some short-term selling. And then we'll have to see, how we do as far as getting defended and getting it bid back up. But I don't think revaluation, it's not a short. And that's the other thing, starting and ending on the revaluation. You don't want to short gold in case they do revalue. But I don't think revaluing gold is front and center until it is of last resort.
Yeah, I think it's doing a pretty good job of revaluing itself right now, just
Yes,
with the price
correct.
going up. So yeah, that can last for a long time. And yeah, I think maybe some pullback here would probably be healthy actually, because it's kind of gone crazy this year. Like you said, the parabolic rise is something that you don't want to see in a healthy bull market. But in any case, it seems like it's going up a lot further in the longer run. And you know, how much risk actually do you think there is out there now, Samantha? You mentioned that it feels like it's being mispriced. Maybe gold's pricing risk correctly, and that's why it's going up.
Mm.
But the markets are not. And if you look at the US, I was just doing the sums on Nvidia: 4.5 trillion, 15% of US GDP, three largest customers are in Taiwan. So if there is conflict
Yes.
in Taiwan, 40% of the earnings of Nvidia come from three companies in Taiwan. If there's a conflict there, then it would crash the bubble in the US. So there's so much risk that I see. But how are you seeing it, and how do you manage that risk on a day-to-day basis? Do you think that now's a time to be taking hedges and money off the table, or is the market correct? We need to be all in on AI right now.
Oh, no, no, I'm definitely not a complacent bull. So, what I do, obviously, since I also run a live trading room, I get to look at all assets across all time frames, from chase to swing to trend. And we still have a very resilient market. There's no question about it. And we've got a lot of, self-interest by the politicians to make sure that it does not fall too soon and too fast. They do have midterms that they have to defend, right, coming up next year. I wrote a post this summer. Maybe you saw it. It was like, no, all gas, no brakes. That was regarding fiscal spending. They passed the OBBA, right, the act that would give lots more money into the things that make the market go yay. And then, of course, Fed cuts. That this expectation that it'd be all cuts, no inflation. Now, though, fast forward, we now have brakes on the fiscal because we have a U.S. government shutdown, something I was really, really sure Trump would want to do. He's not afraid of them. He's done it before. And this one could be very long lasting because he wants power of the purse, and he's getting it. And he's making some decisions that may not stick, whether it's tariffs, and he'll find other ways, right? Supreme Court type of ruling, firings, furloughs that turn into firings, which are also very dangerous for our Main Street because it will pull recession risk forward. But again, Supreme Court will come in and decide whether that's allowed. And lots of this doesn't involve Congress. He's just making these decisions, and then they have to be overturned. But there's that creation of expectation that they're going to be overturned. And the market is still looking ahead to the productivity gains that we don't have right now from AI, but is expected in the future. And it's very rare, actually, that we've had the revisions higher and higher over the next year, specifically allocated to the mega cap tech plays and that semiconductor ecosystem, because the government is still very, very focused in incentivizing those industries to reshore here. And so there's going to be money flowing into this industrialization, this industrial renaissance. But the market always gets ahead of itself. And for example, they've got 29 nuclear plants under construction in China. We have none. We have lots and lots of need for rare earths, but in the US and with partners, they have to be found, extracted, refined, right? And China is the world leader in this area, in extraction, in refining. And we can't just change that because we wish it to be changed. It's kind of financial fiction. So the market is still running up on the expectation that Trump will cave, the fiscal spending will continue to be very robust, and the Fed will just continue to cut. That will make the monetary easing, give us this economic growth engine. But none of that is pricing in the risks. None of it, right? So it's all buyers, no sellers. And then whenever there is any potential chance for markets to actually try and sell off, then we've got a situation where Trump comes in and says, you know what? We're going to see if we can get rid of capital gains taxes. So, people are like, maybe we shouldn't sell. Why would we do that now? So he's got lots of levers and rhetoric that he pulls to keep the investors firmly engaged, right, with all of this monetary illusion, financial fiction, financialization. And people love to be lied to. And the market just likes to make lots and lots of money. And that's what it's doing. So it doesn't really want it to end. On the other hand, Fed absolutely can lose control of the long end of the curve, and rates can increase even in a recession. And that's what's not really expected, because they're not transitioning from monetary, dominance to a fiscal dominance backdrop where term premia stays very, very bid as they continue to try and finance all of this fiscal on basically adjustable rate mortgages. So we just have this short duration mindset. And eventually there'll be failed auctions. There'll be a dollar that falls fast. And right now it falls gently. It keeps everything bid, but the rate of change matters. So if we have a dollar falling very quickly, yields spiking up or down, we can trigger much more volatility that is harder for Trump to put back, together. Last time it was trade tariffs. He announced them. We dumped. The markets dumped, and bond market convulsed. The credit markets also froze. And then he said, just kidding. We're going to delay him for 90 days. Everything's going to be fine. We're going to pass this bill. We're going to get lots of money. So I can watch all of that because I'm literally in front of the screens 12 hours a day and engaging with clients who have their respective expertise. So it's really about tactically making a position. All right, I'm going to trade this, or this is a great investment, because timeframes matter. So that's what I basically do, is put together, okay, this is a tactically bullish market, but I happen to still be macro bearish for these reasons until I see some of my risk event triggers, which are, we start to have a real solid breakdown in breadth, in selling underneath the surface, which I'm very good with my indicators of sizing up on different time frames. We get dollar yen volatility, which I'm also very good in timing the yen carry trade unwind. So these are things that I'm looking for at the same time, watching yields and dollar like a hawk to kind of support this narrative of, yes, the markets can still have a bullish impulse into end of year because it's seasonally strong. We can also have earnings disappoint this season, and we can have some volatility enter because we're due. We're absolutely due. But we haven't gotten to a point where the macro event risk of rare earth ban is set in stone. And so the market will continue to price out the bad and price in the good until they have no choice. That's how they work.
And where does the US consumer fit into this, Samantha? I'm talking people, let's say, living paycheck to paycheck, maybe $30,000, $40,000 a year. How does that square up with S&P valuations? The revised job numbers down, I think in August, was it nearly 1 million down? So is the deterioration there going to at some point impact the markets, or do you think that they can decouple the two and that it's not going to affect them?
So this decoupling on the consumer lending sector is an article that I wrote back at the end of September, that the consumer lending sector is in trouble. So we have Wall Street and then we have Main Street, and they're quite bifurcated. So I write a lot about the employment backdrop as underpinning, the complacency and or the rising risk. And I have not been bearish on a recession, as I mentioned last June of 2024, again in December, again in June of 2025, until the end of this year, because the employment trends have been degrading underneath the surface, that which I track. So big picture, there's nothing, to let's see, no need to panic until there's a reason to. But the point is, I could see this degradation underneath the surface. And then, of course, over the past 2.5 years, we got revised job growth numbers in, and it equaled 2.5 million in revisions lower. So this is the problem with revisions, actually. They go from March to March, and then they're announced in September, August timeframe, and then the final numbers aren't delivered until the following January, February. So it's a massive lag. So I have to find other vehicles to track this weakness. And my point was, in saying in the last few posts where I've written about this, is that we've lost our buffer. So we had a buffer last September of 2024 when we had an 818,000 job growth revisions. And then lo and behold, the Fed did a surprise 50 basis point rate cut, right? We still had a buffer. Now, fast forward to this particular August non-farm payrolls, when we still had the government open and BLS was working, they had a revision of 911,000 losses, and the Fed only raised only cut 25 basis points. Why? And I said this even before they announced. I said, if they cut another 50 basis points, they are going to be admitting recession. They're going to be admitting we've got recession risk pulled forward. It'll be faster and the market will not like it. And so they only went with 25 basis point cut. And there's talk about, how many they're going to do moving forward. But the reality is they're between, a rock and a hard place. They cut too aggressively. Inflation picks up. It already has. We don't have a deflation impulse when it comes to real prices. What we do have is weakness in the employment market. And we've got income, disposable income falling, which obviously leads to more concerns at the consumer level. So the surveys have been right in the toilet, but that will eventually lead to consumer spending downturn. Right now, we've got, the top 50% making this spending look robust, but that's the K-shaped economy, right? So we've got this situation where the Wall Street gains benefit the top income earners, not the bottom. The inflation helps the top income earners, definitely hurts the bottom. And I'm not just talking about auto lending, right, as a canary in the coal mine. I'm talking about the aggregate consumer lending market has slowed from mortgages to what have you. And it doesn't mean that the housing market is going to be a bubble and break. No, we're still in a lot better situation than whatever you read by the foreclosure bros. I'm not a foreclosure bro as it relates to to housing. That is an inflationary asset. It's part of this monetary illusion that prices are much higher assets that are inflationary because of the falling value of the dollar, because of this absolute fiscal dominance that has also caused the Fed to buy mortgage-backed securities. So Powell talked yesterday, how they're going to slow and then, the quantitative tightening in their balance sheet. But they never mentioned selling any MBS, holdings, because that would immediately reprice the housing market. So there's a lot of bid in this market that is government driven, and meaning, of course, Trump, Bessent, et cetera, don't want to create volatility in the equities market, because then they lose their base. Then they lose the tax receipts that come. And by the way, 97% of tax receipts are paid by the top 50% of income earners as well. So we're not really looking at Main Street as much as we're just focused on Wall Street. And I think that's terrible. But that's what the market continues to price in: the ability to have the consumer keep spending, for the earnings growth to expand, and for the Trump administration to basically do whatever is necessary from a policy intervention standpoint to keep the market from rolling over. Once it starts, obviously, we're going to be in a different situation, because it's a credit cycle, and it will be just like every other credit distress down cycle, but we're not there yet.
Yeah, well, we don't know what skeletons will come out of the closet then as well, in terms of bad collateral and poor accounting. When that downturn does come, we could see something nasty. But also, can the US really afford a recession right now, given the amount that's riding on this AI boom, and for Trump in terms of his political status? So just as a final question, Samantha, if we do enter some kind of recessionary period, what do you think the response would be? Would it be an inflation response? Would there be stimmy checks again? Would they have to do some kind of big stimulus to pull us out of that? Or could they afford to let this one actually roll out and have, maybe a deep recession to kind of get rid of some of this credit stress?
Yeah, this is not something I could predict. They definitely will wipe out lots of, the credit stress, but there's still, again, a monetary money bubble that has cushioned every dip, right, has gotten bought, because of the expectation that we can navigate through policy intervention. The other side of that is looking very seriously at the China trade wars, which are not priced in, and the quality of credit, which is not priced in. The Potemkin village that is the hiding, an obfuscation of the actual lending that has degraded underneath the surface, but again, not priced in. I think for the most part, this recession would be stagflationary, right? We have the rising prices and slowing economic growth, but we still do have a backdrop of this reshoring and industrialization that is being forced on the U.S. so that it doesn't come without a lot of money printing and investment by the U.S. government, which by in and of itself is a floor, right? So if you know that the government is going to now act as venture capital, this is very different than the Fed put. The Fed is impotent right now. They really are, but not as much as the federal government, which, by the way, under the three main branches, is firmly in the control of the GOP, and Trump getting his way, also with the shutdown, to further control the power of the purse. Bulls, have a lot of reason to expect higher prices. Does that make sense? So this K-shaped economy will continue. This is clear. Gold and precious metals and metals in general as an inflationary bid, as a geopolitical risk-off type of bid, as a settlement of trade, external drain bid, and on and on and on, will likely follow through and then some. But as it relates to markets just falling apart, when you have a money bubble, the only thing that's really going to break it is if the U.S. dollar crashes lower, not falls slowly, but crashes lower. And they're going to do anything they possibly can to prevent that.
Wow, it sounds like a rocky road ahead, Samantha. And I think you've laid out some of the ways that listeners can continue to maybe protect themselves from that. I guess if they're gonna try and come out of that recession, and if there is a recession indeed, or if they're going to fulfill on some of these industrialization plans, there's going to need to be a lot more money put into the system somehow, and that's going to be inflationary. So maybe the blow off top will happen and it will just bid up prices. But if gold continues as it has done this year to outpace the S&P 500, then it's kind of a no-brainer to be there. But the rest, I guess, is for intelligent people like you to stock pick and find the right market moves to outpace inflation as well. So where can listeners find you one more time, Samantha? Just for my listeners, I'm sure a lot of them will be interested in the Substack. So is it Samantha LaDuc on Substack?
Yeah, correct. So we're just trying to navigate this like everybody else, right? Put together the plot and the motivations and time this market honestly to stay long or to protect, to position and profit for sure on these sector rotation themes, whatever they may be, and tactically lots and lots of stock selection. So I run a live trading room at LaDucTrading.com, and I have a fabulous bench of experts that support our members. We're doing it, like I said, macro to micro at LaDucTrading.com. And then I have a mini me project, which is at Samantha LaDuc, where I'm just posting my market thoughts and then a recording of the live trading room for those who want to, dig in. But I cover every day, a few hours worth of a lot of material. So it's not really a macro discussion or rant like this. It's very much market moving news, policies that dictate price, sector rotation, when to stay long, when to protect. And right now, I think it is time to protect on those precious metal holdings because, like I said, this rate of change that can become, a parabola that then slows, traps longs. I don't care what the sector is. These parabolas are trapped longs that then that last in, first out kind of thing can trigger volatility and then some liquidation. And so we need to kind of be mindful of these running parabolas and bear market rallies. And that's what we trade every day at LaDuc Trading. So thank you so much for having me on the show and asking me more of the macro backdrop. But don't panic until we have a reason to. How's that?
That was great wisdom. Thank you so much, Samantha. It's been a pleasure, and I look forward to hopefully speaking again in the future.